Mergers and acquisitions, M&A, is one of the most powerful forces in global business. Every year, trillions of dollars change hands as companies merge together or one company buys another. In this video, you are going to learn exactly how these deals work, from start to finish, the way investment bankers understand them. First, let us clarify the two terms. A merger happens when two companies combine to form a single new entity. Both sides are roughly equal. An acquisition is when one company purchases and absorbs another. In practice, most deals are acquisitions even when politely called mergers. The acquirer has the power, the target has the price. Companies pursue M&A for several reasons: to grow faster than organic growth allows, to eliminate a competitor, to access new technology or talent, to enter new geographies, or to acquire an asset trading cheaply. Each deal has a strategic thesis, and investment bankers stress test every thesis before advising a client to proceed. A horizontal deal combines two companies in the same industry at the same stage: two airlines, two banks, two pharmaceutical companies. The core logic is synergies: eliminate duplicate costs, gain pricing power, and emerge as a stronger competitor. Horizontal deals face the most antitrust scrutiny precisely because they reduce competition. A vertical deal acquires a supplier upstream or a customer downstream in the supply chain. Amazon buying a logistics company is vertical integration. A carmaker buying a steel producer is vertical. The goal is to control more of the value chain, reduce dependency on third parties, and capture margin that was previously going to outside suppliers. A conglomerate deal combines companies in completely unrelated industries under one ownership. General Electric was the classic example: jet engines, financial services, healthcare, and media all under one roof. The theory is diversification and capital reallocation. In practice, conglomerates often underperform because management lacks the expertise to run unrelated businesses well. Every M&A deal follows a defined process. It starts with strategy. The acquiring company, with guidance from its investment bank, determines why it wants to do a deal, what kind of target profile it is looking for, and how much it can afford to pay. This phase produces a prioritized target list. Next comes confidential outreach. The investment bank approaches potential targets on behalf of the buyer. If there is mutual interest, both sides sign a non-disclosure agreement so detailed financial information can be shared safely. This is when the target opens its books, sharing financials, customer lists, and internal forecasts. Then comes the valuation. The bank runs comparable company analysis, precedent transaction analysis, a DCF model, and potentially an LBO analysis to determine what the target is worth. This produces the football field chart, showing a range of values under each method, which anchors the initial offer price. Every M&A deal has two sides. The buy-side bank advises the company making the acquisition. The sell-side bank advises the company being acquired. Banks can work either side on different deals. Each side has different analysis to produce, different information advantages, and different incentives during the negotiation process. Before winning a mandate, banks prepare pitch books, detailed presentations with their credentials, market analysis, and a preliminary valuation of the client or target. Pitch books run 30 to 80 slides and take teams weeks to build. Winning the mandate is the prize. It means you run the deal and earn the success fee. To understand M&A pricing, you need enterprise value. Enterprise value equals market capitalization plus total debt minus cash. It represents the total value of the business, what you would pay to own it outright, free and clear of any debt but without keeping any cash. Enterprise value is the number that appears in deal announcements and that bankers negotiate. When a company acquires another, it almost always pays more than the current market price. This premium, typically 20 to 40% above the undisturbed share price, reflects the value of control. You pay extra because you are acquiring the right to run the company, set strategy, and unlock synergies unavailable to ordinary shareholders. Synergies are the value created by combining two companies that neither could create independently. Revenue synergies come from cross-selling each company products to the other customers, entering new markets together, or gaining pricing power by eliminating a direct competitor. They are exciting to model, but also the hardest synergies to actually deliver after close. Cost synergies are more predictable. Eliminate duplicate headquarters, consolidate overlapping departments, renegotiate supplier contracts at greater scale, shut down redundant IT systems. Cost synergies are the reason horizontal deals lead to layoffs. Bankers model them conservatively. Markets have learned to discount aggressive cost synergy projections from management teams that have incentives to close deals. Acquisitions are financed three ways: cash, stock, or debt. Cash deals are clean and certain for the seller. Stock deals require shareholder approval from both sides but preserve acquirer cash. Most large transactions use significant debt financing, which is cheaper than equity and generates tax benefits from interest deductibility, but also increases the risk of the combined entity. A leveraged buyout, LBO, is a special acquisition structure used primarily by private equity firms. The private equity firm contributes 25 to 40% equity and borrows the rest, using the acquired company-owned future cash flows to service the debt. The analogy is buying a house with a mortgage, but the mortgage is repaid by the house-owned rental income. Once a deal is agreed in principle, due diligence begins, a deep, structured examination of every aspect of the target company. Financial statements, tax records, legal contracts, customer relationships, technology systems, HR policies, real estate, and environmental liabilities are all reviewed. A secure data room hosts thousands of documents. Lawyers, accountants, and consultants spend weeks analyzing everything. Deals can be structured as stock purchases or asset purchases. In a stock deal, the buyer acquires all the company shares, and inherits all its liabilities, known and unknown. In an asset deal, the buyer selects specific assets and liabilities to acquire. Asset deals offer better legal protection for buyers but are more complex to execute and often more expensive from a tax perspective. Most M&A deals are friendly, both boards agree to proceed. But sometimes a bidder goes directly to shareholders over the board objection. This is a hostile takeover. Famous examples include the 1988 R.J.R. Nabisco buyout, immortalized in Barbarians at the Gate, and Kraft Aggressive, eventually successful hostile pursuit of Cadbury in 2010. Target companies have ways to resist hostile bids. The poison pill dilutes the hostile bidder's stake if they cross a threshold percentage. A staggered board makes it very slow to replace all directors and take control. The white knight strategy finds a friendlier acquirer to outbid the hostile party. These defenses buy time, they rarely prevent a determined, well-financed acquirer permanently. Large deals require regulatory approval before closing. The Federal Trade Commission in the United States and the European Commission in Europe review whether a deal would harm competition. They can approve the deal unconditionally, approve it with required divestitures, or block it entirely. The more concentrated the resulting market, the higher the regulatory risk, which can kill deals months from closing. Investment banks earn two types of fees. The retainer is a monthly fee paid while working on the deal, it covers the bank costs regardless of outcome. The success fee, typically 0.5 to 2% of deal value, is paid only when the deal closes. On a billion-dollar deal, the success fee alone is $5 to $20 million. Bankers are powerfully motivated to get deals across the finish line. From first conversation to closing, M&A deals typically take 4 to 12 months. Small private deals can close in 90 days. Large public deals require 6 to 12 months for regulatory review, shareholder votes, financing arrangements, and due diligence. Deals can and do fall apart at every stage. Material adverse change clauses and break fees are how both sides manage the risk of deals dying late. When a deal is publicly announced, the press release tells you everything: the total deal value, the premium paid, the expected closing date, strategic rationale, projected synergies, how the deal is financed, and whether regulatory approval is required. Learning to read deal announcements quickly is a core skill for anyone working in or studying finance. M&A deals are priced in multiples. EV divided by EBITDA is the most common. Software companies are acquired at 15 to 30 times EBITDA. Industrial companies at 7 to 12. Healthcare at 12 to 20. Understanding what multiple is normal for a sector is essential. It's the first reality check on any valuation and the shared language bankers use when negotiating price. Closing the deal is only half the battle. Post-merger integration, combining two organizations into one, is where the value is either captured or destroyed. Culture clashes, incompatible technology systems, talent departures, and customer confusion are constant risks. Studies show 50 to 70% of deals fail to deliver the value promised. Serious acquirers begin integration planning before the deal closes. History's biggest deal disasters are instructive. AOL and Time Warner, the largest deal ever in 2000, destroyed hundreds of billions as internet and media cultures proved incompatible. Daimler and Chrysler failed because German and American management styles couldn't coexist. Sprint and Nextel combined networks that were technically incompatible. The lesson: cultural and operational fit matter as much as financial logic. Investment banking is the primary entry point into M&A careers. Analysts spend 2 to 3 years building models and pitch books at brutal hours. Associates manage deal processes and client relationships. Vice presidents and directors originate new business. Managing directors close deals and develop client relationships over decades. Exit paths include private equity, corporate development, hedge funds, and venture capital. To go deeper on M&A, read Investment Banking by Rosenbaum and Pearl, the definitive textbook used by analysts at every major bank. Study real deal announcements on SEC.gov, follow Bloomberg and the Wall Street Journal for live deal coverage. For structured training, Wall Street Prep and Breaking into Wall Street offer comprehensive M&A courses trusted by candidates at Goldman Sachs, Morgan Stanley, and every major firm. Here is what you learned today. M&A is how companies grow, consolidate, and reshape industries. Deals follow a structured process: strategy, outreach, valuation, due diligence, negotiation, financing, and integration. Investment banks advise on both sides and earn substantial fees at close. Synergies justify the premium, but integration execution determines whether those synergies are ever realized. In our next video, we go deep on DCF modeling, the core analytical tool behind every deal valuation.